words about the man who we honor with this lecture series, John Kuszczak. These lectures mean a lot to me personally because John was one of the very first people I met when I first joined the bank in 1984. I started in a small group with John and this other guy named Steve Polas in what was then known as the Department of Monetary Financial Analysis, now the Financial Stability Department. Later, John and I worked together closely again in what was then called the Research Department, now Canadian Economic Analysis, where John led the economic projection team. John worked at an exciting time in central banking. He started at the end of money targeting. He saw the birth and the application of a new era of inflation targeting, and that brought with it a tremendous amount of innovation. And this included powerful new forecasting models to answer a whole new suite of questions. John was right in the thick of it. When I first started at the bank, it didn't take me long to see that John was a meticulous researcher, and he held himself and everyone around him to a very high standard. John led by example. John was a thoughtful researcher. His research frameworks were always theoretically sound, and his research was carefully executed. He was curious. John was also skeptical. He was skeptical of the latest research fads and the latest management doctrines. But above all, John was a wonderful colleague because he only wanted the very best for you and your research. If a newly arriving economist ever felt tempted to take a shortcut, John was there to keep us in line and remind us of our commitment to excellence. And he did it all with a dry sense of humor. The other thing about John was it was never about him. John was not one to draw attention to himself or overstate his conclusions. For John, it was all about the bank's important work for Canadians. John believed in markets, he believed in the public good, and he believed in our mission. And in doing so, he inspired everyone around him to do the same. John wasn't much for vision statements, but I can tell you he embodied our commitment to a better Canada every day. John's untimely passing in 2002 left a huge hole, both here at the Bank of Canada and particularly in the life of his wife, Sheila MacDonald, who's joining us here today. And I'm very glad you're here, Sheila. I am so pleased we are celebrating John's memory with this lecture series, and I know how honored he would be to have Nobel laureate Jean Tirole deliver this year's John Kuszczak Lecture. So without further ado, let me pass the podium back to Deputy Governor Schembri, who will formally introduce this morning's lecture. Thank you. And Larry, back to you.
Governor. Good morning, everyone. Bonjour à toutes et tous. I'm honored to have the opportunity to introduce Professor Jean Tirole, this year's John Kuszczak Memorial Lecture. John is Professor of Economics and the Honorary Chair of the J.J. Lafont Foundation at the Toulouse School of Economics. We are most fortunate to have him with us this year. John has had a brilliant academic career with path-breaking contributions to both theory and policy, spanning a wide array of fields in economics. These include industrial organization, regulation, finance, macroeconomics and banking, and behavioral economics. He has published over 200 peer-reviewed articles and 12 books. This immense and widely cited body of work has been recognized by many awards and honorary doctorates over his career. And I could easily spend the better part of an hour listing them all, but of course I won't, because we're all here to listen to him, not me. Suffice it to say that he was awarded the prestigious Nobel Prize in Economics in 2014 for his outstanding research accomplishments, in particular his definitive and most influential work on market power and regulation. Sa présence aujourd'hui est un très grand honneur pour la Banque. car il est le premier prix Nobel à donner la conférence John Kuszczak. Originaire de Troyes en France, Jean est diplômé en génie et en mathématiques. En 1981, il a reçu un doctorat en économie de MIT. Au fil des ans, il a conservé un lien avec cette institution où il a été professeur ou professeur invité de façon presque continue. It was at MIT I met John. My favorite story about him is that I was preparing to write a waiver exam for a course on welfare theory. To make a long story short, some problem set solutions from this course found their way to me. I studied them closely as I was amazed how clear and concise the answers were to difficult problems. After I'd passed the exam, thanks in large part to these answers, I asked who they belonged to, and the response was Jean Tirole. And as far as I know, Jean's answers have been circulating amongst MIT students ever since. As I alluded to earlier, one of the hallmarks of his work is his ability to analyze very complex issues and explain them in an intuitive and accessible manner with direct implications for policy. In this, he shares similar traits to John Kuszczak himself, as Governor Macklem mentioned, who had a practical and thoughtful approach to answering important macroeconomic questions and was also always interested in the common good. Not surprisingly, one of John's books is the most widely cited, widely used graduate textbook for industrial organizations. And his most recent book, Economics for the Common Good, provides a very insightful and, in my view, a very inspirational exposition of the application of economics to important policy questions, outlining both its benefits as well as its limits. I would strongly encourage you to read it. I learned a great deal, and I'm sure you will as well. His lecture today, entitled Digital Currencies and the Common Good, Models and Co-opetition, is based on chapters from his book. His analysis of the changes and challenges we are facing with increasing digitization is clear, perceptive, and far-sighted. Our increasing reliance on digital technology has changed so much about how we go about our daily lives. L'impact de la numérisation sur la façon de régler nos achats des biens et services est un bon exemple. Aujourd'hui, c'est avec grand plaisir que nous écouterons Jean nous faire part de ses réflexions sur l'évolution de l'écosystème des paiements et sur des aspects comme la confiance, la protection de la vie privée et la propriété des données. Alors, sans plus retarder, je passe la parole au professeur Jean Tirole. Please, John, go ahead.
Monsieur Tirole, on ne vous entend pas. Est-ce que votre micro est muté? Vous n'êtes pas muté dans WebEx. Est-ce que vous pouvez signaler?
Donc là, je suis reparti. Là, je recommence. Je recommence, c'est bon. OK.
Vous pouvez commencer.
Ok.
Merci.
Voilà. Tout d'abord, je suis vraiment désolé pour cette assistante technique et je voulais vous remercier pour l'invitation. J'aimerais être parmi vous aujourd'hui. Malheureusement, ce n'est pas possible. En tout cas, un grand merci. I would like to thank Larry and Paul for very, very kind words. And also Governor Tiff Macklem for a very nice evocation of John Kuszczak. It's a very great honor for me to be giving this tribute to John Kuszczak. I'm humbled by the list of scholars who have given this lecture in the past. And I'm also humbled by the topic itself, which is a very technical topic, all the more that the Bank of Canada has contributed heavily to that topic. So a number of people in this room actually have done important work and know more than I do about this topic. All I can contribute maybe is some kind of different angle to the topic. So let me share my slides. Okay. Sorry, so here are the slides. Okay, so let me just say, okay, so I would like to share a few thoughts about the broad technological evolution. To start with, the Fintech evolution, and then I'll get into more specialization into private money, cryptocurrency, and CBDCs. Okay, so let's start with technological evolution. And using a very wide brush, what I have in mind is the integration of technology into financial services. So borrowers can have access to new sources of funds, both on the debt side and on the equity side. The consumer can access new vehicles for savings and insurance. And of course, there are alternative payment systems, which we are going to discuss today, and other things. And the big question, of course, is that a standard technological change, or is that a paradigm shift? And in my own view, it's a standard technological change. It's big, but it still obeys the fundamentals that have been important in the past. So, okay, now it's my screen, which doesn't, sorry. Okay, so any new technology comes with some social benefits, so in general, some cost reduction or some service improvement, a better consumer experience. We see that with mortgages. It also goes together with the entry of new players who are going to disrupt the incumbents. In general, using new approaches. So they are going to use big data, for example, in this case, or new information about the consumer. So if you look at how Ant Financial in China entered the lending market, they've used new data sets, many e-commerce data sets. Also, firms will use monitoring programs for auto insurance and so on and so forth. And then you may get rid of intermediaries as well. Also, I would say are social benefits, but of course, social costs as well. So, for example, when you bypass existing regulations, one of the things that worries me most in the new evolution is the ease with which you can actually reselect in health insurance, and that's really the converse of health insurance, which has to apply to everyone, not only to the healthy people. Same thing if you have crowd lending platforms which have insufficient equity, but basically are banking platforms and so on and so forth. So it should not be the case that the technology allows the private sector to evade regulations. And finally, of course, you have job destruction and creation. Now, in terms of, okay, sorry, I have some trouble with my screen as well. So in terms of investor trust, let me remind you that asymmetric information is really the essence of financial friction. Fintech can reduce those frictions possibly, but the fundamentals remain. So over millennia, at least centuries, institutions have developed to deal with asymmetric information, both pre and post funding. So large players are going to intervene to screen out bad borrowers. They will write detailed contracts, covenants and governance. And after the firm has been funded, then there will be the Hirschman exit and voice mechanism operating with passive investors like speculators in the equity market or depositors, wholesale depositors in debt markets who will exit, while others are actually not exiting, but are trying to exercise voice in governance. So those active investors might be on the equity side, venture capitalists, they could be block shareholders, they could be a board of directors, and on the debt side, there will be relationship lenders. But this is a very sophisticated set of players and strategies, and for that reason, I doubt that there will be limits to disintermediation. So active monitors monitor, active investors monitor, but so do regulators. And again, that's something which is very familiar to you. Securities and market authorities, of course, are playing a big role at the issuance stage and in secondary markets. Prudential regulators are crucial to ensure there is enough liquidity coverage and solvency. So we just cannot presume that informational asymmetries will go away, and those intermediaries, be they private sector intermediaries or public sector intermediaries, will disappear with the new technologies. Now, let me talk a little bit in more detail about private money and cryptocurrencies. So the contours of the digital payments are still in the making. There are many variants. As you know, there are thousands of cryptocurrencies. There is private money. I mean, today everybody is talking about Libra, but of course there have been attempts before Libra, and there will be many further attempts. Every big tech company wants to introduce its tech pay. And of course, there are central bank digital currencies, which are very important. Again, many variants. And what's going to happen in the next few years, honestly, I don't know, but I would like to share with you a few thoughts about this particular thing. What's in it for the players? Well, on the demand side, the users, they want low transaction costs for payments, low fees, low collateral, especially for cross-border payments. But they also want to be able to engage, say, in micro-payments for micro-contributions. And there are many of those on the web, for example. So that's one very logical demand, a very legitimate demand by the users. They may want to escape from dysfunctional monetary systems, okay, where there is, for example, hyperinflation and so on. But of course, there are aims which are less palatable, so like money laundering, crime, tax evasion, some vague libertarian ethos. So there are all kinds of demand sides, as there are kinds of supply sides. The entrepreneurs, they may want to directly profit from it, either in seigniorage, so issuing new coins, or maybe by imposing transaction fees like merchant fees. And there may be also ancillary benefits like data collection might be one of. So clearly for Facebook, for example, Libra is also a way of getting even more data. Another stake, of course, for all of us is private sector innovation. So as I said, cost efficiency, better consumer experience with payments. And it turns out that, say, Europe, for example, has been very slow at creating integrated public payments. Now we have SEPA in Europe for backend, which is actually very convenient, but there's nothing, front-end schemes for citizens. Of course, we still rely on payment cards and credit cards and the like, but we haven't yet public payments. The world is even slower, of course, and as Benoit Cœuré was here yesterday said, Libra has been some kind of wake-up call for central banks. Of course, for example, the Banque of Canada started working on that long before Libra, but by and large, that's been a wake-up call for central banks. So now we have an ongoing or upcoming, I don't know, currency war. So, very schematically, you have public permissionless cryptocurrencies like Bitcoin. We have private permission systems, and I will put the big tech currencies there. And of course, we have the official systems, which are still to be created, central bank digital currencies. Now, what for? Well, there's a trilogy for payments: the store value, medium of exchange, unit of accounts. The store value, and Bitcoin for the moment has been mainly a store value. It doesn't have to be safe. I mean, just like a stock market is a stock of value, it can be quite random unless, quite volatile, unless you are looking for a safe asset premium. I mean, there's a shortage of safe assets. I mean, a bit less now, but there's clearly a shortage of safe assets usually. And to ensure the safe asset premium, you have to be safe, right? And there will be competition in the payment space. Now, who wins that kind of competition is based on several things. The first is trust. And of course, for trust to exist, there must be some stability, some commitment on the monetary base. And possibly, if you want to be an international currency, you have to engage in swap lines and lender of last resort operations. So that's one thing. It doesn't suffice. There are very important network effects in payments, and that was discussed yesterday as well. I want to use the same currency as you do. I don't want to be changing currency all the time, using converting currency all the time, and there are issues with various currency risks and the like. So there are very important network effects. We don't want to be dealing with many currencies. We want to be dealing with one by and large. But the multiplication of platforms, of course, raises the issue that we might have fragmentation. And if we have fragmentation, we're going to lose some of the network benefits. And on top of that, the currency areas which are formed, in particular by those public and private platforms, are not optimal currency areas. When I was a student at MIT, I started working on bubbles. And at the time, I wanted to have a definition of a bubble, which I viewed bubbles as being the difference between the market price of an asset and its fundamental. So the fundamental basically is the present discounted value of dividends, coupons if it's debt, rents if it's real estate, enjoyment that you get by looking at a painting, and so on and so forth. A pure bubble is one for which there is no fundamental. So what is a pure bubble? And Bitcoin, to some extent, is a pure bubble. A very ugly but rare stamp that you are going to put in a bank doesn't bring you any enjoyment value, but may be very expensive, is a pure bubble. But in general, there is some fundamentals. So fiat currency, we might say it's a pure bubble, but at least in the short term, you can pay your legal your taxes, and it's legal tender, so it has some value. Especially you can pay your taxes with it. Of course, after a while with inflation, it might actually not bring you much benefit. Gold, if gold had no value, people will be using gold for industrial usage. Real estate has a large fundamental, which is a present discounted value of rentals, but there is also often a bubble on top of that. Same thing for stocks. But the key thing about bubble, of course, is that they may collapse by definition, by their very definition, and they can be extremely volatile. And for cryptocurrencies to be used as a means of payment, and not only as a store of value or as a speculative instrument, they must be transaction friendly, and they must meet two challenges that we are going to develop. The first is price stability. And as I say, if it's a bubble, it's going to be highly volatile. So that has given rise to a rationale for stable coins, of course. And then there are two-sided platform aspects. It has to be attractive for ordinary transactions, and that has both a level component and a structure component. So it must be the case that it's a method which is not too expensive for both parties, but it also must be the case that the party who decides which payment method to use has an incentive to use that payment method. So if you think about Bitcoin, for example, there are transaction fees, but then there are also entry and exit fees for fiat currency. Unless everybody uses Bitcoin for everything, there will be entry and exit fees, and of course there is a cost of doing so. Now, if you are a cardholder and the card is accepted and you have a cashback bonus card or whatever card with some benefits to that, you would prefer using the card rather than this cryptocurrency. By the way, the same is true on the private platforms like a tech platform, which can try to twist the structure of payments in favor of tokens and against the central bank digital currency by enlisting a number of merchants who prefer merchant program. And the consumer is promised a price discount, maybe 5% for any purchase. And that, of course, makes token attractive. I will come back to that later on. Stable coins, so let me take up the first challenge. Stable coins basically have a backing in terms of reserves. So they must have sufficient capital adequacy and sufficient liquidity. So the question is what collateral? So for the moment, the collateral we have in mind is mainly fiat currency like Libra. It could be bank deposits. It could be over collateralization in cryptocurrencies. That I think is much more dangerous. And that collateral must be segregated, prudentially supervised, which raises an issue about who supervises the reserve fund when you have a global stablecoin. And if you don't have enough capital and liquidity, who is going to act as lender of last resort in case of a run? Now, we don't know much about those topics, but we have to be careful with that. There's been some kind of worry about Tether recently. I think that was last year or a year or two ago. Tether has a 1-for-1 dollar reserves. But when you look carefully into it, or when I looked into it at the time, Teaser was only lightly audited. Actually, it was not even an accounting firm which audited the reserves. And it was written that assets may include from time to time loans to affiliated companies. And that's very worrisome, I must say. From time to time, of course, is when it goes wrong, right? I mean, it's only at that point of time that the platform has an incentive to actually make loans to affiliated companies. And the minting policy is opaque on top of that. So there are concerns. I'm not saying it's wrong, but I'm saying there are concerns. So that's the first thing is that there is issue about this prudential supervision. The second thing is about two-sided markets and what's called best price guarantees. They're also called MFNs, so most favored nations. I like better best price guarantee. By the way, there are 6 or 7 different names. It's also called price parity, and there are many others depending on the industry. So this is representing in this diagram where you're a platform, so it could be a Google Pay or a PayPal or American Express payment platform. And you as a platform user, you're going to use the payment method of the platform when you buy some goods at the merchant. Now that involves 2 things. The first is that the merchant will have to pay a merchant fee to the platform, so it might be 3%, many, or American Express, or many of the tech pay platforms are going to request, say, 3% as a merchant fee. So if you give $100, only 97 will be paid to the platforms. But at the same time, it almost always includes the best price guarantee. So the platform requests that the merchant doesn't charge a lower price for someone who doesn't use the platform. So it might be in that particular case, someone who pays by cash or by check or through Visa or MasterCard or something like that, another platform. And that sounds great because you as a tech pay user, you say, I'm going to get the best price. So I'm going to use my card, it's wonderful. So I'm a winner here. The problem with that comes in when you think about who is paying the merchant fee. So those 3% of the transaction, who is paying for that? And the answer is that it's not the tech pay users. Actually, everybody has to pay for it because you have promised the platform to have the same price for everyone. So if the tech pay platform has 20% of market share in the payment system, 80% will be passed through to non-platform users. It's one of the rare cases that I know in which you can tax your competitors. That's the dream of any firm, right? Everybody would like to tax his competitors, and you can do that thanks to the MFN. And by the way, it's very widespread. It has nothing to do with payment systems. Booking is going to ask for 20% of the transaction to the hotel. Amazon will ask for 13% of the transaction on Amazon Marketplace, and so on and so forth. So if they're not regulated, they all ask for the best price guarantee. Now, reacting to that, we have had structural remedies, which consist in prohibiting various forms of MFN. So in 3 or 4 countries in Europe, including France and Italy, MFNs are prohibited, totally prohibited. Actually, that was Emmanuel Macron who did that in 2015 in France. Sometimes it's a weaker form, like a narrow form. So the merchant can charge less on another platform, but cannot charge less on direct sales. So it's due to the showrooming argument. The idea is that you could use Booking and their good service. You find the hotel room you want to go to Montreal, for example, and then once you have found the right hotel, then you call the hotel to get a lower price. And basically, this prohibition of broad MFNs, but allowance of narrow ones is basically addressing the showrooming argument. In Europe, we have had cases with Booking.com, with Amazon, and this is going to amplify because tomorrow, all your nice personal assistants that you have at home, get Alexa, Google Homes, they will do exactly the same. So Alexa, call me a doctor, and then the doctor will have to pay 25%, right? And so on and so forth. Now, we don't always use structural remedies. Sometimes, I'm sorry. The last structural remedy I want to mention is another prohibition of an MFN, but in the case of payment cards, which is a no surcharge rule. So basically, the idea is that you cannot charge more for someone who pays with American Express or Google Pay than if you pay by cash. You know very well that in Canada, actually, you had a recent class action lawsuits. In Europe and the US, you have those weird situations in which the federation is allowing surcharges, but a number of member states actually prohibiting surcharges. Okay. Now there are two problems with structural remedies. The first one is that actually MFNs are bad, but they also have rationals. They have also good aspects. One is that they prevent showrooming, which in a sense is the expropriation of platform investments. You get the service from the platform, and then you move on to the direct website of the seller, for example. Conversely, you can have surcharging. I'm sure that has happened to every one of you. You go to a website to book a flight, and then you spend a fair amount of time. You call your family to coordinate, and then you give your name and your address and all the information. And then after half an hour, you are told in the last screen that you have to pay $10 or $15 more for getting the ticket. Okay. So a no surcharge rule also avoids this kind of experience, which, by the way, don't happen that often. They happen for a very specific set of businesses. The second issue with MFNs is that they are not effective. MFN prohibitions is that they are not very effective. Actually, you see a lot in Europe of businesses which practice MFNs without being forced to. Why? Because they are worried that Booking.com, for example, is going to downlist them if they don't. That's the implicit threat. There is the explicit threat, which is, by the way, is legal. It's called a preferred partner program, in which you say, okay, I'm going to top list you, and in exchange you'll have the MFN. It's legal because it's an option. It's kind of crazy, right? As a loophole, but it's legal. So if you think about it, there are issues with externalities. There are three elasticities: the consumer side, the platform side, and merchant side. So the consumer is going to choose a platform, and by choosing the platform and, for example, the payment method, may not actually choose what is cheapest for the merchant. Conversely, the merchant might accept the platform or not accept the platform. By not accepting the platform or the payment method, it may actually deprive the consumer of his or her preferred method. And then, of course, you have the point of view of payment of the platform, which actually has to make a living for supplying the service. And the literature so far has looked at the first two, because the impression of both practitioners and also the theory is that cards are must-take cards. I mean, it's not always the case, but it's very difficult for merchants to refuse a card. And there are good reasons for that, which are listed here. Even if the card is expensive, you may not want to turn it down because consumers may not come, you may not be able to reach the consumers, you may lose high margin sales. So basically the literature has addressed the first two, and has applied some Pigovian approach to capping the merchant fee. So it's a non-structural approach. It's a cap approach. In Europe, we have capped using the tourist test. So basically, the idea is that given that the consumer has a choice of payment method, you make the consumer internalize the welfare of the merchant by capping the merchant fee at the merchant convenience benefit of using the platform. If you are worried about platform entry, it's a bit broader. So my colleagues, Renato Gomez and Andrea Montovani, have a paper in which you cap the merchant fee at the merchant convenience benefit, just like in the tourist test, but then you add the consumer information benefit, which is created by the platform. In their paper, basically, the platform enlarges the consumer consideration set so for example, you're able to find hotels that you would not have found otherwise. How am I doing on time, Larry? Can you tell me a little bit how am I doing on time?
John, you have 10 more minutes, please.
I'm sorry, I'm not hearing you. I'm not hearing you, Larry.
10 more minutes, please.
10 more minutes, okay, thank you.
Sorry.
So I promise I talk about CBDC. So let me just express my reservation about private money. I mean, there are several challenges. I mean, I like the innovation that goes with private money, and that I like a lot. But at the same time, private money, which will be unregulated, I don't like for many reasons. One is that I don't want it to serve for money laundering and terrorism, but also for tax evasion, and there are many taxes which can be evaded using that kind of money. And we could come back to that when we discuss compliance with the rule of law. I worked a lot on privacy too, so I'm kind of embarrassed to say that, but that's something which is very important to think about. The loss of seniorage, I don't think the seniorage should be either wasted through proof of work mining of Bitcoins or privatized just like in ICOs. Okay. Okay, I have trouble going through the slide again. Okay, there are competition policy issues which are important. There are challenges for financial stability that have been discussed yesterday. There are issues with counter-cyclical monetary policy. As we know, you cannot just rely on fiscal bailouts of banks. Under asymmetric information, it's important to use untargeted instruments in times of crisis, and altering interest rates is important for that. And there's this recent paper by Benigno et al., which addresses this issue. And finally, there is prudential supervision, which is very important. Don't forget that all those price payment systems may become shadow banks. Okay, and if they become shadow banks and there is a problem for whatever reasons, I've listed some here, there is an issue about what's going to happen if fragile players like small depositors or SMEs or other regulated financial intermediaries are hurt by default of that shadow bank. Now, with Emmanuel Forhi, we have insisted on saying there is a good rationale for the current architecture of the financial system with state insurance services, be it lender of last resort or deposit insurance, going hand in hand with regulation. Regulation reduces the cost of providing those state insurance services. So there's a good reason why you have this trilogy of things. And also we enlarge this trilogy by saying that it also explains why you might want to ring-fence regulated institutions from shadow banks. So there is a broader issue about what you do, and we haven't experienced that, of course, but with payment systems. But when those tech platforms, payment platforms go burst, what do you do? And then, chances are that that there might be bailouts. Also, the international aspects of the match might actually operate in our favor in that case. So let me conclude with a few thoughts about CBDCs. I'm a bit embarrassed. I don't know if I'm a bit out of my comfort zone, but on top of that, there are many people in the audience who are actually much better expert than I am. And actually, the Banque of Canada has been doing research on this for a long time. So that's been discussed yesterday. You might want to establish a public platform to avoid the bypass by private platforms, the loss of control of the currency. The state has some advantages for that. The state may define what legal tender, in what currency the taxes are to be paid, and may have also some incumbency advantage. For the moment, it does, and given that there are network authorities, it better do that before the private sector has taken over. At the same time, as was discussed yesterday, there are fewer instruments than private money private money has many dimensions to play its currency attractive. And as Benoit Curé said, and others said, obviously, the government is not as innovative as the private sector, and therefore there is a need for competition. There is competition and cooperation at the same time. And that's emphasized both in this recent report of the BIS and the several central banks, including the Bank of Canada and by the People's Bank of China. This kind of competition seems to be very important. You want to enable private sector innovation in payment systems at the front end, point of sale, P2P, online. Now, the question is how, and there is a continuum of possibilities there. I'll discuss two possibilities. One is intermediate access, with DG wallets being linked, somehow being demand deposit of some form, maybe in a smaller form, so you might mimic physical cash, or you could give a much broader access to households and non-banks, wholesale and retail depositors. Okay, so the first possibility is retail DC wallets akin to demand deposits. They might be managed by the bank, by a third-party provider. They also might be managed by the central bank too. But if we want innovation, we might also have a bank or something like that actually managing it. The idea is to empower depositors, maybe sometimes against their bank actually, to avoid the fee of their banks and getting more innovation, maybe on their telephone or something, on their smartphone or something like that. De facto, those wallets will be part of insured deposits. And probably they should be treated as such. I mean, today you have deposits and you have payments. Both, I'm not talking about the current situation of interest rate, but in terms of low interest rates for the depositors, you have payments by banks to the deposit insurance fund, and also the counterpart, which is regulation, of course. And this is a payment for a service which is provided by the state, and only the state can provide that service, to be providing liquidity in tail risk. That enables a safe asset. But then that suggests that there should be a maximum per depositors in consolidated terms, the initial deposit and DC wallet. But there are two key things. I mean, there's the issue about privacy. I mean, do you want to keep some of that, maybe $5,000 or $2,000 mimicking and being completely private, mimicking some kind of cash, and then the rest being visible to authorities trying to clamp down on crime or on tax evasion? That's one question. And what about data ownership? Those transactions are extremely valuable to provide credit, to monitor tests and trends, and will be given access. So do you want a user-centric approach, or do you want a financial institution-centric approach? And those will be important questions. Now, let me just say, not everything should be digital currency, central bank digital currency. And if you look at deposits, if you just look at banks and their deposits, not all deposits are meant to be safe, meaning protected from default and vulnerability. Not all deposits are supposed to be short-term. Okay?
Excuse me, John, 3 minutes, please.
Sure, that's fine. And if you look at simplified balance sheet of a bank and at the banking system as a whole, I would say it's just like a power grid system. Basically, when you need power, when you need cash for a bank, you are going to dispatch. And you are going to dispatch first your very liquid assets, level 1, level 2, and so on. You're going to go down the pecking order. And the other thing you can do it on the liability side is to ration for power or to bail in for banks. So you're going to start with equity, and then you're going to go into junior debt and so on. But the point is, and we realize that more and more, that not all deposits should be non-bailable. They should not be de facto insured. Okay, so there is a term issue. Not everything is short-term, and not everything is safe, and that's something which is important to understand. Okay, so as we know, the bank grant credit. They take demand deposits and short-term deposits. They lend long. The riskless nature of deposit is provided by the state as a part of a quid pro quo against regulation and deposit insurance premium. And when the interest rate are positive, is a low interest rate. And there is transformation, and narrow banking is suboptimal. Now, if you bypass the banks, the question is how do you do it? And that's a very big issue. The government doesn't have expertise to grant loans. It can be even worse, actually. It may even engage in favoritism and be lenient with insolvent borrowers. So that's no good. Okay, those are questions we have to ask. And I would like to conclude with this. The new technologies offer wonderful new opportunities. But at the same time, we should not forget the fundamentals. Information asymmetries, delegated monitoring, two-sidedness of payment system, rational for central and traditional banking, architecture of financial system. And those who don't remember histories, as is well known, are condemned to repeat it. I'm tempted to say as a series that those who don't remember theory are doomed to rediscover it. Now, I would like to thank you very much for your attention. You probably haven't heard me because of a technical default, but I just wanted to say I'm very, very honored to be paying tribute, participating to this tribute to John Kuszczak. And thank you so much for having me today. And I look forward to your question, and apologies for this technical problem.
Thank you very much, Jean. Merci beaucoup. It was an excellent lecture, I think very informative and very useful for all of us. I mean, it's a very challenging area of research, and we benefit greatly from your insights. So let's start with a few questions. The first question is from Harold Ulag. What would be the distinguishing feature or distinguishing features of a privately administered digital currency that make it different from a credit card network platform today?
Okay, well, I think the question is how much credit they could create. So sure, I mean, if they are 100% backed by currency, then they're not going to create much credit, but in the end, they might create a fair amount of credit. And they could become shadow banks very easily. Another difference, I think, is that they could make direct use of data. Now, credit card platforms, they also collect data, of course, and they resell those data. But in terms of Facebook and Google collecting those data, given that they don't resell and there are already data barriers to entry, that might reinforce their dominant position in data. So, but that's a specific argument, I guess. That's not your question, but it's an argument which is more specific to Facebook and Google.
Okay, thanks, Mr. Jean. The next question is, what are the benefits and drawbacks to a publicly administered digital currency versus a privately administered digital currency?
Well, I think, I mean, maybe Larry, you should be discussing this rather than I do. But I think for all the reason I gave, private digital currency is not great because you lose control over the money supply. Just imagine what would have happened in 2008 with Libra as a currency. It would not have been very easy to handle, to be honest. And then you have private seniorage, and then you need to oversight to avoid money laundering and tax evasion, blah, blah, blah. There are many, many things. And then in the end, you do have to have some prudential thing. But as I said, the private sector is much better at innovating. And that's why competition is crucial. And I think the central banks are just right on this point. I mean, when they are very cautious about moving into CBDCs, I think they are right. I think they should introduce CBDC. At the same time, they don't want to suppress innovation. So they have to find a way of enabling platforms which will enable them to do all those things that I was saying are missing with private platforms, but at the same time, let private platform benefit from innovation.
That makes sense. Thank you. In terms of one question I had was, when you look at central bank digital currency, how do you address issues like one of the benefits of cash is how close can we make it to cash in terms of anonymity and whether a central bank digital currency should potentially pay interest?
Okay, so anonymity, that's a trade-off I was alluding to, which is we don't want anonymity because we want to avoid crime and the like. At the same time, we don't want the central bank to know everything about ourselves, right? So are we going to, that's one of the things, I mean, in my slides, I put a question mark, which is how can we organize this? I mean, today, in a sense, we're already using banks as intermediary. So the bank is supposed to report on some behavior it finds anomalous, and there's something fishy there. And possibly if the tax authority has some doubt, it can have access to the bank account history. That could be the same with the new system. And you could have a small pocket which would be totally private, just to mimic, as I said, the physical cash. But at the same time, you want to use it for more than that, in your computer or TV or something, and then I'm going to spend much more than $1,000, right? So, I don't know. I mean, this is the kind of thing we have to find the right way to do it. On the interest rate front, that's a difficult one. I see CBDC, as I told you, more as a payment thing, right? I mean, for large payments, you do have wholesale clearing of the line. It already exists by now, so I'm not too worried about that. What we want is to be able, as consumers, or maybe SMEs, to have small payments which will be cheap and easy, right? So, for instance, you can have an interest rate, sure, actually negative interest rate at this stage. At the same time, you can have a deposit account with zero interest rate and not a negative one, right? The zero one, as we know, we don't know exactly where it's at, right? And that depends on the amount of cash in circulation, right? I think in the long term, physical cash will disappear, more or less. And a lot of people, I guess, in the room will disagree with me because they will say we need physical cash in order to get privacy. Maybe some people are not exactly, I don't know. That's possible, but it will move things. So the advantage, of course, with having cash disappear and having a negative interest rate is that you can go even beyond what's done now to escape the law of zero lower bound, as you know.
Right. No, that's just, I mean, there's a number of proponents of taking advantage of the fact that we could impose a negative interest rate on digital currencies and allow for more easing in terms of monetary policy, provide more stimulus. I mean, as you know, another MIT grad, Ken Rogoff, was a proponent of that.
Yes, he has a very good book actually on those things.
Okay. Another, I guess, the last question here is: can MFNs be good if merchants have too much market power? For example, the credit card issuers may be doing a collective bargaining with the merchants to get better terms for credit card users.
Okay, that's an interesting thing. So, should you allow, if the payment system has too much power, should we allow the merchants to form a coalition and basically have collective bargaining with the platform? And you know, that would be a possibility that will reduce the merchant fee. Some countries have done that. Actually, China has done that. I believe Canada, right? I mean, I may be completely wrong. Canada has done that. It's very rare because it has to be supervised. I mean, Section 1 of the Sherman Act and also the same thing in other jurisdictions, private boycotts, right? Because of course it's monopoly power, and you don't want that in general. Now you might say the payment platform itself is a monopoly, so we establish some kind of symmetry. That's a possibility. I would say the alternative will be to put a cap. I mean, I'm more in favor. I know it's not easy, but we are doing it in Europe, and we academics must actually contribute more to guidance of such caps. But basically putting a cap on what the platform can charge. And it's a much broader issue. And again, you know, if you think about how to regulate all those other platforms using MFNs, you need to design caps because with the threat of delisting or downlisting, the prohibition of MFNs won't work.
No, that makes good sense. So thanks very much, Jean. Merci beaucoup. Encore, c'est une grande plaisir pour nous d'avoir. That's the end of the lecture, and so we'll stop now. So thanks again, Jean, and it was a pleasure to have you. Au revoir.
I'm very sorry. you